Hi people, how are you? I hope you are fine, healthy, and in pink of health. The latest move by the government to keep interest rate on small saving instruments unchanged. It has come as a setback for small investors. When the inflation is over 7% and the bond yields have risen over 7.4%, so this decision will not only result in negative real rate of return after adjusting for inflation for savers and pensioners, but also the status quo is likely to prompt banks to go slow in the hiking deposit rates. So what unchanged small saving rates mean for bank and savers? We'll discuss this and few more points like, are the rates attractive? What does it mean for banks and savers? What have been the recent trends in the interest rate? What has been the impact of negative returns? So let's get started. So, are the rates attractive? See, considering the retail inflation that hit 7.97% in April and 7.04 in May, the existing rates on small savings schemes they might have disappointed savers, even though these are higher than banks' fixed deposit rate. So, RBI expects retail inflation to be above the upper tolerance level of 6% until the end of next year. Also, as per yesterday's decision, schemes like Public Provident Fund, the National Savings Certificate, they will continue to carry an annual interest rate of 7.1 and 6.8% respectively in the first quarter of the next fiscal year. So the 1 year term deposit scheme, it will continue to earn 5.5% interest rate in the second quarter, and the term deposits of 1 to 5 years will fetch a rate in range of 5.5 to 6.7% to be paid quarterly, while 5 year recurring deposits will earn a higher interest rate of 5.8%. Okay, so what does it mean for banks and savers? See, banks are now unlikely to go for major hike in deposit rates. Had the government hiked small saving rates, they would have been forced to go into steeper hike in deposit rates to prevent the money flow from banks to the small saving schemes. But further, when stock markets they boomed in 2021 after the crash of March April 2020, so investors pumped a record amount of money into the stocks and mutual funds. Now, with markets showing huge volatility in the wake of rising rates and foreign portfolio outflows, savers are looking back at bank deposits and saving rates. So much will now depend on the quantum of the rate hike that the RBI announces in the coming months. So what have been the recent trends in the interest rates? See, small saving rates they are linked to yields on benchmark government bonds, but despite the upward movement in government security yields, the government has not increased the interest rate. As of Thursday, the 10-year benchmark bond yield has risen to 7.45%, up to 140 basis point in the last 1 year. So RBI has also raised the repo rate by 90 basis points to 4.90 during the April-June quarter. A lot of figures, right? But I guess it's important. Yeah. So the interest rate on saving numbers they were slashed by 40 to 110 basis points for the first quarter of 2021-2022. But the decision was later rolled back with the finance minister saying that the orders issued by oversight shall be withdrawn. So what has been the impact of negative returns? See, while the inflation is over 7%, the 1 year bank fixed deposit is now at 5.3%. It means depositors are losing money after adjusting for inflation. So there aren't many options for savers and depositors. Markets are risky and volatile. They can't play around with the retirement money. On the top of this, the country lacks a proper social security system. Although governments and semi-government employees they get pension after retirement, technically negative retail rates they discourage saving and they boost consumption. This in turn may fuel more inflation. So I hope you have this basic understanding of economics. What is inflation, how is it affected? If you do not have, please let me know in the comment section. I'll explain these terms in detail. Okay, so this in turn has may fuel more inflation and lead to even more negative retail rates. So keeping the interest rate low for too long can have negative consequences. How have bank responded? See, after after the RBI hiked the repo rate since May, the banks have started raising the deposit rates. Earlier this month, SBI raised rates by 15 to 20 basis points on some retail domestic term deposits below rupees 2 crores. The rate for senior citizens are higher by 50 basis points for these tenures. Other banks have also increased the rate. So the hiking bank deposit rates will also depend on the credit demand, which has now started showing signs of growth. So the banking system has been sustaining a liquidity surplus since June 2019 on the account of built up deposits due to higher growth in bank deposits versus the credit disbursement, except for the last couple of fortnights. So it is however important to note that if small saving rates are not raised, the banks would not be forced to raise rates unless they need to mobilize funds for credit demand. Had the government raised saving rates, bank would have been forced to raise fixed deposit rates. Okay, so what can investors do now? See, while one can strategize to invest in good debt product yielding better returns, experts say that equities are the best option for beating inflation and generating a positive real rate of return. So while small saving instruments are offering lower rate of interest than 10-year government security yields, trading around 7.4%, of financial advisors say individuals in the highest tax bracket, they can go for high rated debt papers and invest in debt mutual funds that are also more tax efficient. So I guess that is for the day upon what things can be done and how these things are affecting. Yeah, but please, as I said earlier, do let me know in the comment section if you have problem with economics related term, be it inflation, the government bonds, the bond yield, how is inflation affected the supply chain cycle. If you have any doubts, please let me know in the comment section. I'll bring up a video on it for sure. So that's it for the day. Thank you. Bye bye. Have a nice day.